Hello, I'm Chip Stites, and this is The Laughing Retirement. Today we're going to do a market update. Now, we don't do these all the time because a lot of the time I don't think there's a whole lot to update. But I think there's a whole lot to update now, and I think it's time to pay attention. So, without further ado, let me share screen here, and there you go. Now, I'm not telling you anything you don't know. The markets are going to drop. Well, that's what they do. They go up and they go down. The issue is not if they will drop, but when they will drop. And you basically have three choices. We're going to talk about what's going on in the markets, where they are today, and some of the things that are happening around the world that I hope make you decide to be proactive in your portfolio. Now, let's take a look. Recent market results. The S&P 500 hit an all-time high of 5487 on June 18th. The Dow Jones hit an all-time high of 40051 on May 16th. The NASDAQ Composite hit an all-time high of 17862 on June 18th, 2024. And the Russell 1000, the largest 1,000 stocks in the Russell Index, hit an all-time high of 2985 on, guess what day? June 18th, 2024. Now, the Russell 2000 small cap stocks hit an all-time high of 2442 on November 8th, 2021. Today, it's at around 2030. So, what does that tell us? S&P 500, largest 500 stocks. Dow Jones, large. Old school, value style stocks generally. Large companies, all-time high. NASDAQ Composite, cap-weighted index, tech basically, all-time high June 18th. Russell 1000, largest 1,000 stocks in the Russell 3000 index, June 18th, 2985. Stocks are high. Now, there's no question that the markets are going to go down. It's just a question of when. Do I know? No, I have no clue. But then neither does anybody else either. The PE ratio is 24.79. Now, that's the price earnings ratio. That's the earnings per share divided into the current price, and that gives you a number. Well, generally, they say when the PE ratio of the S&P 500 is over 28, you have a problem. Right now, it's 24.79. In addition to that, 2024 is an election year. Now, most of the time, politicians want markets to be very good to them during the election year because people vote their pocketbooks. So to say that this market is going down this year, I think is probably a stretch. But to say it's going down and to say that it's probably made most of what it's going to make in this cycle, that's a safer bet. There's another way of telling, and that's to look at inverse funds. So let's take a look at a couple of them. Now, SDS is one. That's inverse the S&P 500. It hit a 5-year low of 2304 on June 23rd. PSQ, which is the QQQs, that's the NASDAQ. It hit an all-time low of 4054 on June 23rd. RMW, that's the Russell 2000, hit an all-time low of 1926 on the same day. So all of these funds, the inverse funds, are at 5-year lows, while the other funds are at 5-year highs. Now, that tells me something. That tells me that In general, most of this bull market is probably over. Do I know? No, I don't. I don't have any more of a clue than anybody else has. But I set up my portfolio so I don't have to worry about that. So let's continue to look at this. Let me adjust this a little bit. Let's continue to look at this, and let's see where we are. Right now, you have three choices. You can do nothing. You can make no changes. You can hope for the best. You can smile and say, hey, my mutual funds are doing great. My portfolio's up. I'm having a good year. It's an election year. Bob's your uncle. Let's go. The guy who's done pretty well in the markets by the name of Warren Buffett said the rule number one is don't lose money. And the more I read, guys like Jeremy Siegel, William Graham, Warren Buffett, Mark Lichtenfeld, David Bosson, David Zweig, the more I read, the more I realize that taking less risk is smarter than taking a lot of risk, because at the end of the day, 3 years, 5 years, 7 years, 10 years down the road, they're going to come out the same. And since everybody has said over and over again, people don't get out at the top, they get out and get scared at the bottom, it makes no sense to take all that risk, does it? It just doesn't. So what can you do? Well, I've already said you can do nothing and just hope. If you're 55 or older and you're going into retirement, boy, I don't like a diet of hope. I want a diet of I know what's going to happen to me. So what can you do? Well, you can take your portfolio gains and you can build cash. You can also do a small amount of inverse funds. Now, you'll notice if you're looking at this that there are a bunch of question marks after that. I put them there for a reason. The reason is very simple. Inverse funds are dangerous. They are not used by most people. Now, I have a deal with myself. I'm not going to talk to you or anybody else about anything that I haven't done myself. Right now, about 2% of my portfolio is in inverse funds. Specifically, my dividend-oriented, low-risk portfolio tends to react more to the Russell 2000 than it does to the S&P 500. And this is something that over time I'm going to correct. So I bought inverse the Russell 2000 and inverse the S&P 500. And I'm going to let them sit there. They pay a little dividend, but that's not why you have them. Now, buying inverse funds is probably the most dangerous thing you'll ever do. I made my biggest mistakes back in 2011, 2012 buying inverse funds. I thought I knew what I was doing. I had had a pretty darn good 2008. My clients had recovered from it very well, and market slapped me in the face. So I'm not suggesting that you buy inverse funds. No. I'm suggesting that if you know your portfolio and you know how it reacts, and you know which indexes it reacts to most, you can take off some risk by putting in a small amount of this. Now, the other choice, the third choice, is to create a portfolio that does not need constant attention. A beta of less than 0.65. My beta is less than 0.60 at the moment. And I am building up cash because I believe somewhere in the next 2 or 3 years, we are going to have a monumental sale that will enable us to purchase things very, very well for our future. So what else? What are inverse funds? Let's talk about that. SH, which I just purchased a small amount of, somewhere around 1% of the portfolio, is one time inverse the S&P 500. SDS is 2 times inverse the S&P 500. RMW is 1 time inverse the Russell 2000. And RMW is 1 time the inverse of the Russell 2000. And TWM is 2 times inverse the Russell 2000. Now, You can also get 3 times inverse these funds. There are all kinds of inverse funds that do all kinds of things, and I am not recommending you use them. What I have learned in making my mistakes for myself and others, and like I said, if I don't put anybody into anything ever that I don't own myself. And one of the things I've noticed is that 2 and 3 times inverse funds, while offsetting risk at a better rate, are also more inconsistent, and I don't like inconsistency. So a one-time inverse fund is a way of risk off, taking risk out of your portfolio. These funds, basically, these ETFs, go up when the market goes down. So you're protecting yourself from a drop to some extent. But if the index goes up, the ETF, the inverse fund, goes down. And we all know that 70% of the time the market goes up. So 70% of the time, the idea of an inverse fund is a bad idea. And for most investors, it's a bad idea, but I want you to understand what's out there. Now, generally, inverse funds are made up of options or puts that bet against the upward movement of a stock or an index. Options expire. And so after 3 months or 6 months, if your ETF is holding an option, that one expires, generally at no value at all, and the owner or the manager of the index fund has to buy another put or another option. And so there is constant turnover in these things, and there is not a lot of consistency. Now, some of them do pay dividends. I've seen 5% dividends in some of them, but that's not a reason to buy an inverse fund. And I'm going to say it again. It's a way of taking risk out of your portfolio. But unless you know what you're doing, unless you understand it, it doesn't make a whole lot of sense to do it. Right now, I have about 2% inverse funds in my accounts. And I'm going to sit there and watch them for a while. Now, I generally don't tell you about problems unless I also make suggestions. I had a boss once, a wonderful man who taught me a great deal. And one of the things he told me was, never bring me a problem without a solution. I don't want to hear your problems. Because what makes you think I'll have a solution for it if you don't? And he's right. So I am not going to tell you this is bad and this is wrong without having some solutions. So here's my solutions. Number one, set up your portfolio defensively in a value style to start with for the long run, because value over the long run will equal growth with less risk. Don't take extra risk. It just doesn't make any sense. Build up cash now. Opportunities are coming. Can I tell you when? No, I can't. But I can tell you that there are mutual funds, at least at Schwab, that are paying more than 5% that are money market. Money market mutual funds paying more than 5%. A CD ladder, 3 months, 6 months, 9 months, 12 months, paying 5.25, 5.35%. So you can earn a nice rate of interest while your money sits there at no risk, while you're waiting for the opportunity that's going to come. Take your gains. One of the things I hear all the time when I'm talking to people is, oh, no, I don't want to sell that now. God, that can go up 10, 20%. God, I'm going to miss out. And inevitably, I said, well, how much have you made so far? Well, I don't know. You see, when is enough enough? If the market has done 10%, or what, 15, 18%, it's done this year, and You've done 12 or 13 or 14% in the stock. What's wrong with taking half of those half of those gains, or 3/4 of those gains? You can't lose by taking a gain. Don't get greedy. Take your gains. Patience and time always win. There's a reason for the fable of the tortoise and the hare, written by that marvelous storyteller, I almost said Oedipus, written by that marvelous storyteller Aesop, the tortoise and the hare. Tolstoy said the greatest warriors are patience and time. It's the same in the markets. Less is more. Set up a defensive portfolio, build up cash now, take some of your gains, put it in money market or short-term CDs, and just wait. Do I think this is going to be a bad year? No, I don't. But I do know this. We had 4 large cap indexes clobber their all-time highs. And we've seen a slowdown since then, a retrenchment. Could it go higher? Sure could. I'll be patient. I'll take the slow road. I'll take a value-oriented strategy and an income-oriented strategy for my future every time. And I think for most pre-retirees and retirees, that is correct. Now, let's move on. Be very careful. If you're considering inverse funds, they're usually very, very short term, and they're used by managers in large mutual funds and ETFs to hedge risk on the short term. So you got to know your portfolio, and I know that mine reacts more like the Russell 2000 than it does anything else. And so I'm going to risk off a little bit in the Russell 2000. Now, no more than 5% of the portfolio. Right now, I have 2% of my portfolio in inverse funds. Use one-time funds, no more. Everything else tends to be erratic. Now let's talk about other developments. There's a lot going on in our world today that I think you have to be paying attention to. The oil-rich countries, and the countries, the example will be the BRICS, Brazil, India, China, are trading their oil in their own currency. They have stopped using US dollars. Now, that may not seem like a lot, and that doesn't affect us right now. But over the long run, it will affect us, because what they're saying is they don't want to pay any kind of premium for a currency that's basically broke. The World Bank has been looking for dollar alternatives since 1995. I began reading about what they were doing and how they were doing it. They're looking for another reserve currency, a currency of trade. And they put together some oil, part gold. Now they're adding the Bitcoins of the world to see if they can find something that is solid and consistent. At the same time, China's hoarding and growing their hoard of gold. At the same time, our US debt is unchecked. Right now, our debt is $34 trillion. When our GDP, our gross domestic product, the amount of goods and services that we put out, is 35.44 trillion. And I think that's a mistake. I think that's 25.44 trillion. I'll check on that and get back to you here in just a second. $25.44 trillion. That's right. So we've got a debt that is almost $10 trillion greater than what we put out in any year. And Congress doesn't look like it's in any mood to do anything but hand out more money. Now, The dollar's drop in value is worrisome. We've had one of the centers for world currency and trade looking for other ways to fund trade around the world other than dollars. You don't understand how, most of us don't, how huge being the currency of trade is. And what would happen to the dollar if they took that away and began using something else? Do I know when this is going to happen? No, I don't, but I think it will over time. So what does that mean to you? What does that mean that you should do? Should you drop everything and run away and buy yuan or rupees or whatever, British pounds? The British pound and the euro are worth more than the dollar, when we have one of the largest economies in the world. And that's at least partially a reflection of out of control debt. So what can you do? Well, number one, you can own gold. I would suggest that you own it outside IRAs, but you can put your entire IRA in gold if you want. I'm not suggesting that by any means. I'm also suggesting that maybe what you want to do is own a foreign currency. Now, there are ETFs with relatively low expenses, 0.40 expense, that will put one currency like the euro against the dollar. So if the euro goes up in value, so does your account. FXE is the euro, FXF is the Swiss franc. Now let's talk about the Swiss franc for a second. It is one of the most consistent currencies in the world. It's also backed by a country that has little debt. It is a consistent currency. And it has been a place to go for years and years and years for safety. The Canadian dollar, the Australian dollar, the British pound are all other places you can put a little bit in to offset some of your dollar risk, because for almost all of us, everything we have is denominated in US dollars. So I'm suggesting overall that you consider what your alternatives are, and you consider what your choices are on many, many, many different levels. So what are your takeaways? Now is not the time to ignore your portfolio or its holdings. I can tell you what the risk in every stock I own is, every ETF or closed-end fund that I own is, every ETF that I own is, and what the total and the average for my portfolio is, and how much my portfolio is going to pay me out this next year at a much lower tax rate. 12 to 15% is the average tax rate that comes out of my portfolio. I've gotten rid of my IRAs. Took some time, but we got rid of them. Well, almost. I've got one thing to get rid of. Lower taxes and expenses mean more income to you in the long run. That's a no-brainer. But how do you do that? We can show you how. There is a better, safer, less expensive, less risky way to manage money. If you have any questions, email me at info@thelaughingretirement. Now, upcoming in the Laughing Retirement, we have a July 13th masterclass on how to legally lower your taxes to 12 to 15%. We're going to have something up on Italian taxes. I talked to a guy day after tomorrow who does US and Italian taxes, who knows the system backwards and forwards. We're also going to talk about renting and buying houses in Italy. The dates of those two are to be decided. So if you have any questions and you would like more information on how we do things here at The Laughing Retirement, please email me at info@thelaughingretirement and just say, Chip, I got a question. How would you do this? What can I do? What are your choices? I'll spend 20 minutes for free with you without much discussion, without any question at any time to try to help you out. If I don't know where to go, I'll find out so that I can send you to somebody who's going to give you reasonable answers at a much, much lower cost. Why? Because if you're paying somebody else to do it, it's coming out of your pocket. If you have a ton of risk in your portfolio, it's coming out of your pocket. Whatever you do comes out of your pocket. And after all, if we're getting close to retirement or in retirement, your pocket's about all you got. So I'm Chip Stites, and this is The Laughing Retirement. And we'll see you next time around on Market Update.